Good day. Welcome to the third module of Fundamentals of Accounting, Business and Management 1, the Accounting Equation. In this video, we will define each major account, discuss its characteristics, and provide examples. Note that pay extra attention to this module, for it is highly essential in analyzing relevant business transactions. Before we actually get to understand the accounting equation, having a good understanding of major accounts is a prerequisite to reading financial reports and posting transactions to accounting system. Each element's role is to define how company's money is spent or received. Each element can be further broken down into several categories. These 5 major accounts are assets, liabilities, equity, revenue, and expenses. Let us start with assets. Assets is defined as objects or entities that are expected to generate cash flow, reduce expenses, and improve sales. Assets are classified into 2, tangible assets and intangible assets. Tangible assets are physical entities that business owns, such as land, buildings, vehicles, equipment, and inventory. Intangible assets, on the other hand, do not exist in physical form but represents money or value such as accounts receivable, patents, contracts, and certificate deposits, for an instance. But most commonly, assets are grouped according to their lifespan or liquidity, or the length of time they can be converted into cash, such as current assets and non-current assets. Assets that are expected to be consumed, sold, or converted into cash in 12 months or less is called current assets. Such current assets are as follows: cash, cash equivalents, notes receivable, accounts receivable, inventories, and prepaid expenses. Cash is any medium of exchange, including coins, currencies, checks, money orders, bank deposits, and drafts. It is also considered as the most liquid type of asset and can be used to easily purchase other assets. So you basically use cash to purchase other assets or any other related transactions. Cash equivalents, on the other hand, are investment securities used for short-term investments in the form of treasury bills, certificates of deposits, commercial paper, and other money market instruments. So it is also convertible into cash and are subject to an insignificant risk of changes in value, maybe or probably because of inflation and interest rates. Notes receivable is a written pledge that customer will pay the business fixed amount of money on a certain date. In simpler terms, if, let's say, the business performed a service or provided products to customers, but instead of the customer paying the business cash, the customer will issue a promissory note to the business. A promissory note is a financial instrument that contains written promise by the customer to pay the business a definite sum of money at a specified future date as seen in the image. So usually promissory note has the date of note issued, the payee, the amount, the interest rate, the due date, and so on. Accounts receivable, on the other hand, is amount owed by clients against the sales of, let's say, goods and services, but instead of note, invoice will be issued. It is the same situation with notes receivable, where the customer is not able to pay for the service provided by the business, but instead of providing promissory note, invoice shall be given to the customer. An invoice typically includes lists of goods or services, the total amount, interests, and the taxes to be paid by the customer or the client. Inventories, on the other hand, is or are assets that are either held for sale, in the process of production, or in the form of supplies or materials to be consumed in rendering service or production. So as seen in the first photo, an inventory can be finished goods in a merchandise, hold for sale or waiting to be delivered or to be distributed, or raw materials or ingredients waiting to be processed or converted into a new different product in a manufacturing company, as seen on the second photo, or simply supplies to be used or consumed in the office, like on the third photo. Last, for the current assets, yes, you have seen it right, prepaid expenses. Prepaid expenses represent an expense that have been paid for in advance. It is considered as an asset because the business is spared from the inconvenience of paying cash in the future for a specific expense. So, prepaid expenses are insurance or either rent. Next, non-current assets. So, companies' long-term investments for which value will not be fully realized within the accounting year is called non-current assets. Companies purchase non-current assets with the aim of using them in the business since their benefits will last for a period exceeding 1 year. However, these assets may be amortized or depreciated. So such non-current assets are property, plant and equipment, accumulated depreciation, and intangible assets. Plant, property, and equipment are both non-current and tangible assets, which include land. So land is defined as the ground business uses for operations or location for headquarters, or it can be space or parking lot, or it can be also a storage used by the business. It can also be a building. So building is a structure completely enclosed walls and has a roof. So it is an infrastructure the business use. Another PPE is machine and equipment. So these are major tools and technology used in operation of the business. So for manufacturing, it could be a grinding machine or assembling equipment. For service business, it could be computer, copiers, telephones used for communication. So other PPE would be furniture and fixtures. So these are larger items of movable equipment used to furnish an office. So it can be bookcases, chairs, desks, filing cabinets, and tables. Lastly, vehicle. So these are cars, automobiles purchased by the company to transport either goods or employees from one place to another. So that's it for the first part of this module. I hope you learned something and thank you for watching.